The Fed spoke today, and what did it do to gold? We'll get Peter Hugg's thoughts next. Peter, thanks for being back on the program.
You're welcome, Daniela.
Fed Chairman Bernanke warning that tightening could end growth today. Peter, any surprises here?
No, in my blog this morning, I suggested whatever the first reaction was in the market would probably be the wrong one. You have to take this into context. The one thing the Fed will not do is surprise the market. And Monday and Tuesday, every Fed governor that could get in front of a camera did, and suggested that the easing program would continue. There's still not enough hard evidence that the economy is on a solid track. And until that evidence becomes more clear, the Fed will probably continue with its bond purchasing. I can't imagine anybody would have thought this morning that Bernanke would have said the opposite in front of Congress. The Fed just doesn't work that way.
Peter, let me ask you, when you say the first move would be the incorrect one, and we saw a $25 move on the upside, what do you mean by that?
Well, I think what the traders saw was, Bernanke's not going to tighten, which I don't think was in the cards in the first place. He's going to continue easing. They said, okay, we got to buy gold because he's not going to tighten. And the market rallied up and the shorts panicked. But it was an illogical move on the upside, and the bigger players took advantage and sold into that strength. Really what we have here is status quo. I mean, there's nothing absolutely that has changed from the last 2 weeks based on what the Fed is planning on doing.
Peter, I know you've been bearish since November 2012, but recently you've told me that you're leaning more towards the bullish side. Why the change in sentiment?
Well, again, as a trader, I look for higher lows, and I have a number of indicators that suggest to me which way I think the short-term move is going to happen. And again, in my world, a short-term move can be a 10-minute move. I'm impressed with the double bottom at 1327, and I suggest it. 1337, and I suggest it may hold. So I'm now looking. I'm not a raging bull, and I'm not like Sojen out there saying gold's going to 10,000. But now my trading strategy is more likely to be something where I buy the dips and sell into the rallies, where since November of 2012, I've been selling the rallies and buying the dips. And I think the economic recovery is starting. I think the Fed will be very, very transparent when they do stop bond purchases. They'll do it very slowly. And it is in their sights to get inflation higher. So I have a sense that the underlying fundamentals are beginning to shift towards a more positive price appreciation in the metals.
Peter, could a sell-off still be in the cards?
Again, I'm a trader, so I have to respect my technical levels. If the double bottom at 1337 doesn't hold, obviously I think we'll go lower. But I think the fundamental overview of the market is feeling better to me than gold did, certainly at 1700. I thought it was way overvalued up there, and I think back even in November I suggested we would see 1400 before we saw 2000. But at these levels here, I'm starting to be selectively bullish on my trades as opposed to being short. There's a huge short position in this market. And I don't want to be caught on a short trade, and this market runs through my stops. Peter,
just to wrap it all up, in order to hit that $1,400 level for gold, do we need to see a close over 1387?
Again, that's my level. If I saw a close over 1387, I'd have a comfort level stepping in, looking for the next major resistance level, which would be the low 1425 range. But again, I'm very cognizant of my initial support at 1362, and if that breaches, I'd be wanting to see 1337 hold before I went long again.
Peter, with the 20 seconds we have left, some quick thoughts on silver.
It's going to trade with the same volatility it always has relative to gold, but silver getting down into the $20 level, in my opinion, is a better risk-return trade than gold at this level. I mean, if I was going to go long for a trade here with gold breaching 1387, I'd jump into silver as a trade, because I do think that the percentage return would be probably 20, 30% greater on a silver trade than gold.
Good thoughts from you today, Peter. Thanks so much for your time.
You're welcome, Daniela.
And thanks for watching this edition of For Pete's Sake. You can email us at newsfeedback@kitco.com. Thanks for watching.